All right, thank you everyone for joining us for this month's edition of the Investment Committee webinar. It's been an exciting month for sure, so excited to get into it, share a little bit of a market update with you guys, discuss some of the recent news stories that we've seen in the market. Then we also have an interesting graph to share with you guys at the end before we sign off. So let's get into it. Looking at the market vitals so far over the last month and this year. I think there's one number here that just jumps off the page. S&P is up 8.3%, but if we look just over the last month, the S&P 500 is up 8.6%. So I think it's pretty staggering that the last month performance for the S&P 500 has actually outpaced the entire 2026 return for the S&P. So if we were sitting here a month ago from today, the S&P was in negative territory. And fast forward to today, we're in a totally different spot given what's happened in the market over the last month. Looking at some of the other major indices outside of the S&P, we see that the NASDAQ has performed exceptionally well, up 15% both in the last month and overall in 2026. The Russell 2000, which is the small cap index, and the total international stock index have also performed very well in 2026, outpacing the S&P 500. And if we look at the aggregate bond index, that's up about 0.5%, and in the last month is actually slightly down. So you've seen that stocks and bonds have not been very correlated over the last month. But it has certainly been an exciting month in equity markets, just given the explosive returns that we've seen from the S&P, the NASDAQ. What have we seen, Brandon, in terms of some specific sectors over the last month and so far in 2026?
Yeah, I think Sean, to your point with the Nasdaq and S&P, if you're looking at the sectors, one of the big takeaways is the technology sector. When last month it was down about 4.5% when we did this webinar, and since that, if you're looking at the year to date, it's up almost 22%, and over the last month it's up almost 23%. And really seeing that, where there was volatility in the market and there was decline and pressure on the technology sector, we've seen that rebound, quickly, and then also continue to show positive momentum, led by, some of the semiconductors, which we'll go into more detail later in the slideshow. But things like AMD, have really been showing positive momentum. And then, same story with, the Iran conflict going on, with the energy sector being up about 28% and still seeing elevated prices from oil. And if you're looking at, the Brent crude oil, that's at about 105 right now. And, we're still seeing that elevated where, before the start of March, it was below that $80 mark, and it's still, hovering at that elevated level for as of right now.
Yeah. You're seeing it at the pumps too. I mean, gas these days is getting a little out of control. So definitely staying elevated with everything that's going on over in the Middle East recently.
Just one thing to highlight, just to give a little bit of context here, is if we roll the clock back to February, and the narrative going on in February was stagflation, Federal Reserve cuts going down, or probability of the Federal Reserve cuts going down, and inflation staying high, growth being weak, and concern about overspend. And if you remember, the private credit stories were kind of, driving the narrative at that time. The Iranian conflict had not started in February. So, the storyline was going back to consumer defensive stocks. People were buying up non-AI related companies. Claude had come out with, its new AI product that had caused the SaaS apocalypse. And so people were selling technology stocks. And then you look at the 1 month performance of the technology sector, up 22.8% in 1 month. Like, if that doesn't make you kind of want to fall out of your chair, and that's a little over 2 months after a storyline of like, you got to sell tech. If you were watching CNBC in February, it was like, you got to sell tech and you got to get back into the cash flow generating, not over investing in their business. I mean, it's just absolutely insane how quickly that narrative changed in a few months. And, thankfully, with the process that we have, we kind of stayed true and kept reinvesting as those technology names got a little bit weak. And that's part of our process. It's designed to not get caught up in those head fakes. But I mean, never while we were doing it, we were like, oh, yeah. And, sometime in April and May, these things are going to, go absolutely, to the moon up 22.8% in a month. It's nuts. So it just kind of shows how kind of crazy, bipolar, and volatile this market remains, but how it's still like just there's so much opportunity. It's really just two sides of a crazy coin. And it can be maddening, it can be frustrating, and it can also be very, very profitable for people. So, those who are regular listeners, those who are first-time listeners, paying attention to this stuff, that it can be exhausting, I suppose, but it's absolutely fascinating.
Yeah, for sure. A few things worth highlighting here. The 10-year Treasury rate is almost up to 4.5%. So if we look at the beginning of March, that 10-year Treasury rate was closer to 3.9%. So pretty significant move over the last couple of months in that Treasury rate. I think there's a couple reasons why we've seen GDP come in higher than expectations, growing at 2%. Recently, we've seen inflation tick up, especially with the conflict in Iran. The last CPI print was 3.8%, and PPI, or the producer price index, came in today at 6%, which was a big surprise to the upside. So between that inflation number really ticking up and GDP being strong, that 10-year Treasury rate has had some upward pressure on it. And I think that also goes to the expectation for Fed rate cuts. The Fed is less likely to cut rates at all in 2026 now, given some of these developments that we've had with Iran, oil prices being elevated, inflation now being elevated. The expectation is 2026, no rate cuts to come, given the economic data that we've seen. And I think the other thing worth mentioning is the US dollar over the last month is actually down almost 1%. So we've had technology up 23% in the last month. And that's been no credit to the US dollar appreciating in value. It's actually down slightly. So that's an interesting view to take is dollar's been slightly down and we're still seeing this incredible run in US markets with a lot of the technology optimism around artificial intelligence and semiconductors.
Sean, just for those who aren't as familiar with the chart on the page, can you just, explain exactly what that's showing?
Yeah. So this is a cool chart that shows the expectations for federal rate cuts, Federal Reserve rate cuts. So this is looking at the June 17th, 2026 Fed meeting that's coming up next month. And it shows what the market expectation is for what's going to happen with interest rates. So right now, interest rates are at that 350 to 375 basis points level. And this chart is just showing that based on market expectations, there's a 96% chance that the Federal Reserve is not going to make any moves with interest rates in the next Fed meeting. So this is something that we're always keeping an eye on. We like to include this chart in every webinar that we do just to share the market expectation for what's going to happen with interest rates. And it's just a good indicator of kind of what the market's expecting. And I think it makes sense given what we've seen with some of the economic data recently.
Just to add to this as well, this afternoon it came out that Jerome Powell is officially going to step down, and Kevin Warsh is confirmed to be the new Fed chair. Jerome Powell will stay on as Fed governor, though, on the board of governors until 2028. So he is officially stepping down, but will continue some involvement as well.
I think one other thing, so, when you look at the Fed probability, you kind of have to look at each meeting over the entire year. And one of the things that's been a little bit interesting is if you looked at it, it was like, the probability of interest rates staying kind of in the same place was kind of the highest probability, or as we've, certainly in the past couple months. But then if you looked at where those other probabilities were, it was kind of in dropping, maybe 25 basis points or 25 basis points. If you now look in the later months, October, November, December, the probability has swung to the other side where people could see Federal Reserve interest rates going up to 3.75 and 4% again. So that is really where the shift has happened. It's not so much where people's, most probable expectation is. It's where if people had to lean on one side of the fence or the other, they used to be leaning hard left, and now they've shifted mildly right. That's a really big deal. So, how big of a deal? We'll see. Obviously, the conflict is happening. Oil prices are volatile. Maybe they go up, maybe they go down. Maybe we get a resolution. Maybe everything shifts back in a little bit. So we have to stay fluid in everything. But recognizing that kind of a shift is really a big deal. So we wouldn't be doing our listeners service if we didn't highlight that.
Brandon, I know CPI is 3.8%. I think you had looked into some of the underlying numbers for that CPI that we just got.
Yeah, and with everything that's going on, when you look at it and actually break down what has like the largest effect of it, you know, gasoline, being up 28.4%, over the past years, the major factor of causing inflation to go up. While there are certain things that are, still up higher, whether it's 4 or 5%, that's really the item that's dragging it up further. Is that, and airline fares are also up like 20%. So those are the only two items that are up double digits, and those are both in the 20%, dragging that up to 3.8%. And if you look at core, which just takes out energy and food, that's about 2.8%. So you can see just how volatile some of that can be from the energy standpoint.
Yeah, awesome.
It's hard to say. They say core is the stuff that doesn't include the volatile stuff. So we're going to take out the volatile stuff. What's one of the volatile stuffs? Oh, one of the biggest inputs. Oh,
Yeah,
cool.
exactly.
All right, so one of the big stories over the last month has been the semiconductor boom. We talked about the technology sector as a whole, but if you really narrow in on what's caused the technology sector to do so well, it's really been here in this sector, the semiconductors. A lot of people are thinking that semiconductors might be overhyped. There's maybe a bubble coming just based off what's happened in the price. But if we really look at the numbers underneath, the semiconductor total revenue for 2026 is expected to reach 1.29 trillion. If you compare that to 2025, that's a 50% increase in revenue. So it's not just hype. That is a pretty significant increase in expected revenue if we look at the semiconductor sector. And just looking at the semiconductor index, SOX, that's up about 68% so far in 2026. So has been an insane run in terms of price movement in the semiconductor index. But that's not completely unwarranted when we look at things like a 50% increase in revenue, and that doesn't even take into account profits or profit margin or any optimizations that have been happening in that sector. So we've seen a few major players making huge moves in the semiconductor industry. So we wanted to break down a few of those big players, what their role is in semiconductors, because I feel like semis can be a very nebulous term. I know they're powering artificial intelligence, but what are the roles of some of these companies that are doing so well?
Can we zoom in a little bit, Sean? Because us with older eyesight are there you
Yeah,
go.
absolutely. So looking at these three companies, AMD has been a big one. That's up 109% so far in 2026. You can think of this as the engine or the brain power. AMD, along with NVIDIA, is really creating the chips that is leading to this boom in artificial intelligence. So that's been the role of AMD. Then you look at a company like SanDisk, which is up 510% so far in 2026. That is the massive library. That's what's building the vast digital warehouses where all of this data is being stored. And then you look at Micron, which is another company that has had a large run up so far in 2026 and is receiving a lot of hype. That's up 179% in 2026. And that's kind of like the conveyor belt. That's what connects the chips that AMD is making with the library that SanDisk is making. So all of these companies play an important role in the ecosystem of artificial intelligence. And I think it's kind of rising all ships as AMD is creating better chips that can produce better outputs and more computing power. You also need SanDisk to be creating better libraries and Micron to be creating a better delivery system and connection. So we've really seen the whole ecosystem of semiconductors boom so far in 2026. You can see it in the revenue numbers, you can see it in the profit margins. So it's not completely unwarranted, even though it seems like an uncharacteristic run or a bubble. Um, just wanted to give a little bit more context into some of those major players that we're seeing in 2026, the roles of those players, and just the overall background of kind of the semiconductor industry right now.
I think one other thing, Sean. So, and first off, I just want to say, we're giving examples of companies in this sector in this boom. We're not necessarily sitting here and making, big recommendations one way or the other.
Yep.
Um, but I think what's important to think about, right? Because a lot of people have been scratching their head and saying, "What's going on? We're at a war in the Middle East, and the market seems to be going up like crazy, and are we missing something, or what's going on?" And I think if you we're in 2026. If we think about the last 26 years, right, the entire century that we've experienced right now, how many years have we been in a conflict in the Middle East of that 26? I don't have the answer off the top of my head, but it's more than 20 of the 26. So when the market looks at the situation that we have and it says, okay, we're in a war in the Middle East, we've been in wars in the Middle East before. That's kind of actually what we've almost begun to expect. When you just have a pick a random year out of a hat, were we in a conflict in the Middle East? Probably. And if you look at how many times did you have a sector with 50% revenue growth in a calendar year? Probably would be searching with a magnifying glass to find an example of that. So when you're confused of these things, because we're familiar with the concept of war, the pictures and images that it creates can be, startling. And so these things create a lot of emotional response. When I say something's growing revenue by 50%, as guys who work in finance, we almost fall out of our chair. But if you don't work in finance, you're like, is that a lot? And that's where I think one of the contexts is it's very important to take off this page. It's not AMD, SanDisk, or Micron, and it's not even, yes, the component parts of what's happening, but the fact that there is something so seismic going on right now in the market that creates an opportunity for an entire sector to have 50% revenue growth is it's like mind-boggling. And this is not the only part that's really benefiting. If you look at the utility sector, normally the sleepiest part of the market, it's up huge this year. Why? Because of all the energy that's going to be needed to supply these guys on this page right here. And there are so many other component parts of the economy which are benefiting either tangentially or directly. Real estate prices are going up because people are buying up space for data center. Like the amount of things that are all happening all at once and pushing. And Sean, you said it, a rising tide lifting all ships. And this is why when we look at this market force and people want to question it because either, they don't like the headlines or they don't like this. How many times have you ever seen the headline, semiconductor revenue growth in 2026 to be 50%? Has anyone read that headline recently? No. It's right here on the page, and that's why we're kind of banging the table and saying it so loudly because this is the biggest thing happening, and it's probably the biggest thing that's happened not in a decade, but probably over 80 years. So, maybe worth looking at.
Yeah. And I remember Nvidia in 2022, that was having 70% revenue growth. I don't think anyone expected that the entire sector now, a few years later, is almost matching what we were seeing from Nvidia a few years ago. So the
You were in shock, Sean.
yeah, no, it's crazy. It is an interesting time and market that we're seeing here.
All right. So to continue the conversation around technology, the tech sector, this chart is basically showing price in blue and then price to earnings ratio in red. And you could see recently here, and this is as of April, right, is the divergence, from price and PE and valuation. So basically, what this is showing is that the value is there for this sector. I think at the end of the day, what the picture that the chart is really painting is the fundamentals are strong enough to support kind of this price story. And it's been a big conversation. People throw, the word bubble around. And when you look at price to earnings and valuation here, this is just a good illustration of where that's at today.
Yeah, I think that's kind of the key takeaway there, Luch, is that every kind of article you read or news stories continues that AI, there's a bubble, but if you're really taking a deep dive into it, of especially past years and then where we are today. I mean, this is as of the end of April, but you're still seeing the price at a relatively high. It's down 1% from the 52-week high, but the forward PE is down 25% from the 52-week high. So you're still seeing highs in the price, but the valuation or the PE being lower than what it was if you even look at the start of the year, given the chart.
Yeah, it's basically earnings is outpacing price change.
Yeah.
And as you can see, the relationship, and this is just a 7-year period. So, oh, I'm sorry, what a 7-year period? It's a 10-year period. This is showing you that that relationship is usually pretty tight. In other words, market follows fundamentals. I think, what we're all trying to say here is the fundamentals have outpaced price, but it's so mind-boggling for people because it's such a rare exception that you see the divergence this big where price is going up, but people almost doubt it because it's like, how could fundamentals be improving at a rate faster than the price when the price is going up so much?
Yeah.
Hmm.
Weird times.
Yeah, and even if you look at the earnings growth for the S&P was what 27% versus the expectations of 13%. So it's another quarter of double digit earnings growth, but outperforming it by 14% from what the expectations were to what actually happened over the quarter too.
Yeah. Profit margins are also at kind of very elevated levels, so that's kind of driving it, right? People think profit margins are usually slightly mean reverting. Um, there's an expectation that oil is going to catch up to us, interest rates are going to catch up to this market a little bit, that some of this investment is going to be have to be written off at some point because we're potentially overbuilding data centers. So this is working in some of the probability risk around the growth right now. So I don't think it's necessarily totally inappropriate. But this does, in my mind, this captures that there's kind of like a 25% possible opportunity if good things happen versus the things that people are concerned about. If everything kind of turns out pretty good, there's almost a 25% opportunity sitting in the market. So that's kind of if you add that 8%, right, that we've made about year to date, call it 8%. And then you say, oh, what about you throw 25% on top of that? Pretty damn good year. It's over 30%.
Hmm.
And that's above the norm, but we are not in normal times, as I'm sure everyone kind of knows. So just kind of always keeping that perspective in, right? There's a lot of scary stuff going on, but then there's also like wait a second, didn't the guys at Green Ridge say if everything goes right, we might like the market could shoot up 25% and that wouldn't even be like uncalled for? Yeah, but we don't know what's happening. We don't have a crystal ball over here, but we have to be aware of both the risks and also the opportunities because we kind of try to look at that symmetrically and always keep in mind, bad things can happen, but good things can happen too.
Yep. Yeah, it's interesting. You don't see another gap of that level on this chart of 8 to 9 years.
Well, actually, if you go back to 2008 and 9, you'll see that chart exactly the
Yeah,
opposite when earnings went negative because of all the write-downs. So, there's
true.
also that private credit thing we could see right there.
Very true.
You just
But as Brandon mentioned also, this chart is as of April 29th. And if
Yeah.
we look over the last 2 weeks, since that date, what's happened? The market has continued to shoot up. So looking since this chart, that gap has probably closed a little bit, as you probably would expect it to, just given what has happened over the last 7 years looking at this chart. So All right. I think that's all we got for you guys today.
If anyone has any questions about some of the charts we put on, we try to always keep this interesting. We kind of like, keep trying to drive the conversation. For those who listen every month, we're not just trying to say the same thing over and over again. And as much as, everything is changing on a very consistent basis, the underlying storyline that we remain focused on has really not changed all that much, other than the fundamental story is kind of getting stronger and stronger and stronger. Um, and so we don't want to sound, like a broken record or something like that. We are trying to kind of add in new conversations. So if you have questions about any of the past charts or the charts we're showing now, we just want to continue the conversation and just kind of pick our brains a little bit more about what we're seeing and, why we think this makes a little bit more sense than maybe, some other folks. We're happy to have that conversation and, just let us know. Otherwise, you know, we got Memorial Day coming up. Swimming pools are opening. Good times.
Bring on the warm weather. Let's go.
Time to get tan.
Oh. All
Yeah,
right,
thank you
guys.
everyone for joining for this month. We will see you in June for the next edition of our investment committee webinar. Appreciate everyone for joining today, and we will talk to you all soon.